Behavioral economics examines the psychological influences on individuals' financial decisions. Traditional economics assumes rational decision-making, a concept challenged by behavioral economics. Emotional and irrational tendencies often drive investment choices, deviating from purely rational calculations. Psychological factors such as cognitive biases and emotional impulses significantly impact financial behavior. Understanding these psychological influences is crucial for making more informed financial decisions. Behavioral economics provides insights into why people don't always act in their own best financial interests. Loss aversion is the psychological tendency to experience the pain of a loss more strongly than the pleasure of an equivalent gain. This bias can lead investors to irrationally hold on to losing stocks, hoping for a rebound. The desire to avoid losses can override rational decision-making and investment strategies. The emotional impact of a loss often outweighs the logical assessment of potential future gains. Loss aversion is the tendency to prefer avoiding losses to acquiring equivalent gains. Investors sometimes refuse to sell assets at a loss, hoping for a future recovery to the initial purchase price. The fear of realizing a loss often outweighs the potential benefits of alternative investment opportunities. This reluctance to sell can lead to suboptimal investment decisions and missed opportunities. Overconfidence bias is the tendency to overestimate one's own abilities and knowledge. This bias particularly affects predictions, leading to inaccurate assessments of market outcomes. Overestimating abilities can result in excessive trading, as individuals believe they possess superior insights. Unwarranted risk-taking is a common consequence of overconfidence, as individuals underestimate potential downsides. Understanding overconfidence bias is crucial for making informed decisions and mitigating potential losses. Overconfidence bias leads individuals to overestimate their own capabilities or knowledge. Day traders often exemplify overconfidence bias by believing they can consistently outperform market algorithms. This overestimation of skill can lead to poor decision-making and financial losses. The illusion of control is a key component of overconfidence bias in trading. Accurate self-assessment and realistic expectations are crucial for mitigating overconfidence bias. Data-driven analysis and risk management strategies can help counter the effects of overconfidence. Herd mentality describes the tendency to follow the actions of a large group. This behavior often occurs regardless of individual analysis or judgment. Herd mentality can lead to buying high during market peaks. Conversely, it can also result in selling low during market downturns. A rapid increase in Bitcoin's price attracts new investors. Herd mentality drives these investors to buy Bitcoin at its peak. These investors follow the crowd without conducting thorough analysis. The lack of individual analysis leads to buying high, driven by FOMO. When the price corrects, these investors often experience losses. Herd mentality can result in financial losses due to impulsive investment decisions. Recency bias is the tendency to overweight recent events when making predictions. This bias leads investors to believe that recent trends will continue indefinitely. Overweighting recent events can distort decision-making processes. Recency bias can result in suboptimal investment strategies. Understanding recency bias is crucial for rational financial planning. Mitigating recency bias involves analyzing historical data and long-term trends. Recency bias occurs when recent events disproportionately influence investment decisions. The rapid rise of tech stocks in 2020 exemplifies recency bias, leading investors to believe this trend will persist indefinitely. Over-optimistic views driven by recency bias can result in inadequate portfolio diversification. Insufficient diversification due to recency bias increases overall investment risk. Anchoring bias is the tendency to over-rely on the first piece of information received when making decisions. This initial information, known as the anchor, disproportionately influences subsequent judgments. The anchoring bias occurs even when the initial information is irrelevant to the decision at hand. This bias can lead to suboptimal decisions due to the disproportionate weight given to the initial anchor. Anchoring bias occurs when an individual relies too heavily on an initial piece of information when making decisions. In investing, anchoring bias can lead to holding onto a losing stock, fixated on the original purchase price. The investor irrationally waits for the stock to recover, potentially missing better investment opportunities. Overcoming anchoring bias requires objective analysis and consideration of current market conditions. Investors should establish clear rules, such as setting stop-loss limits, before making investment decisions. Predefined stop-loss limits help to automate decision-making and mitigate emotional interference. Take-profit limits allow investors to secure gains at predetermined levels, preventing potential losses from market fluctuations. Setting rules in advance helps to combat biases that can negatively impact investment outcomes. Automating investment decisions through predefined rules reduces the influence of impulsive reactions. Adhering to established rules promotes disciplined investment strategies and consistent performance. Maintaining a decision journal helps investors track their reasoning for buying or selling assets. The journal entries should include the rationale, data, and assumptions behind each investment decision. This practice promotes self-awareness by highlighting patterns in decision-making. Reviewing past decisions allows for reflection on potential biases that may have influenced investment choices. Consistent journaling improves investment strategies by identifying strengths and weaknesses in the decision-making process. Decision journals provide a structured framework for continuous learning and refinement of investment skills. Diversifying investments across different asset classes reduces overall risk. Diversification mitigates the impact of any single investment performing poorly. Diversification prevents over-reliance on any single sector or asset. Asset allocation is a key component of diversification, ensuring a balance across various investment types. Diversification strategies consider factors such as risk tolerance, investment goals, and time horizon. A diversified portfolio aims to achieve a balance between risk and return. Pausing before investment decisions allows emotions to subside, reducing impulsive reactions. Rational and informed choices are facilitated by taking a deliberate pause. Impulsive decisions are often driven by emotional responses rather than careful analysis. A pause provides time to analyze data and consider potential risks and rewards. Informed investment decisions lead to more stable and predictable outcomes. The primary challenge in investing often lies in managing one's own cognitive biases. Recognizing cognitive biases is crucial for safeguarding and enhancing an investment portfolio. Self-awareness is a vital component of disciplined investment decision-making. Actively managing cognitive biases is essential for rational investment strategies. Disciplined decision-making protects and grows investments by mitigating the impact of psychological pitfalls.